Good afternoon, ladies and gentlemen. Welcome to Market Guru, a series of shows that we do with the finest brains on Dalal Street. It's my pleasure to welcome Mr. Daljeet Kohli, the head for equity investments at Roha Asset Managers. Mr. Kohli is a long-term veteran of the market. He's been tracking equities and other asset classes over the last 3 decades. He's made money for his clients in bull markets, in bear markets, in volatile times, in quiet times, in times where earnings have slowed and in times where earnings have accelerated. Let's see how he feels these days. A very warm welcome to you, Daljeet ji. What a pleasure to host you. How do you see sentiment on Dalal Street these days when the Nifty is unable to cross 25,000 points but is still at 8-month highs?
Okay, thanks for your show. See, what last week did on the week or so, this sentiment is slightly disturbed. Every day we are hearing all this, but this is, I think, only very short. We expect that this year it has that kind of things many more because somehow the world. Picking up some issues.
What are the 2 or 3 reasons, Daljeet ji? What are the 2 or 3 reasons, Daljeet ji, why you feel that we should be in a better market than what we see now over the next 5 to 6 months?
Yes, that's very important, Shailesh, because there are confluence of many factors which is happening. First and foremost, which is the most important for equity markets, is the So you see corporate earnings. If you notice, quarter full earnings were here. We are expecting that one.
Okay, what we'll do, ladies and gentlemen, is we'll try to get hold of Mr. Kohli in a while we the PCR fixes the back end. There is some crackle in the noise that is there. The market today, ladies and gentlemen, on the weekly expiry of the Sensex is flat. The Nifty is down 93 points. There's a bit of profit booking, about 0.5% down on the banking index, 55,675. But what is in top shape are defense counters, very strong moves that are coming in terms of strong volumes and strong upticks. Look at Moscow Dock. After 3-4 days of rest, this shipbuilder is up 3.7%. Volumes are to the extent of about 58 lakh shares. It's the second most active counter on the National Stock Exchange. About 1900 crores worth of shares of Moscow Dock have been traded. And apart from that, you have a very strong move in a competing shipbuilder, which is Garden Reach. Look at Garden Reach shipbuilders. This is down to the extent, this is up to the extent of about 3.5%. 3,163, same story, down for 3-5 days after a record high, and now the cyclical uptick is beginning. A strong move coming into Cochin shipyard as well. There is a green tick on BEL early morning. You saw a price of 408, a record high on this one. Bit of profit booking happening there. Now out down about 0.5% or 2 rupees at 401.8. Okay, what we'll do is now we'll again try to reestablish contact with Daljeet ji and see if the noise is now clear. Namaste Daljeet ji, can you hear me? If yes, how do you think sentiment is on Dalal Street these days?
Yes, Shailendra ji, I can hear you now. Thanks for having me on your show. See, I think sentiment will keep changing over days and nights depending upon the tweet what you get, no? These days, tweet has become more important than anything else. So that is a barometer of how things move in the market. But what we feel that this is only going to be a temporary thing. Volatility will remain in the market. However, our view on the long term on investment purpose, I think we are very bullish. We feel that markets are in for a good time, and probably in next few months, maybe before Diwali or so, we should be touching much better returns in the next few months also. Now, why I'm saying all this, because there are confluence of factors which have become positive for the market. Let me take one by one each of them. The biggest factor is corporate earnings. Markets were rattled in last 1 year because of the no growth in the earnings. Now we saw H1 was total washout. Quarter three was slightly better, and then quarter four came up much better actually. In fact, if you see quarter four earnings, the broader markets did far better than anybody's expectation, and we hardly had any kind of accidents in this quarter earnings, etc. Now, although downgrades were still there, but if you see the broad base earnings picture was much better. Now we will.
Yes, I think I think there is some issue with the link today. Daljeet ji is unable to be in touch with us in a continuous fashion. While the PCR fixes it, let me just tell you where the market action is apart from the defense counters that we're discussing. Ladies and gentlemen, second day running, it's the IT stocks that are in top shape. Look at the Nifty IT index among the few indices in the green and about 1% higher. If you see from 7th April onwards, when the index hit a low of about 32,740, it's been a straight one-way climb. The index has added more than 7,000 points in a span of about 10 weeks. So in about 45 50 trading sessions, the index has actually surged about 7,000 points, and today it is now consolidating above 200-day DMA. The last time you saw 39,450, it was 24th of February, and all sorts of stocks are contributing to this uptick. If you look at large caps, then TCS and Infosys, HCL Tech, Tech Mahindra and Wipro are holding the flag up for the IT stocks in the Nifty. When you look at mid caps, there are strong gains happening on old favorites like Happiest Minds, now up about 7.5%. There is decent gains happening in Tanla Solutions, 3.4% higher, 680. And my PCR tells me that Daljeet ji is back with us. My sincere apologies for this issue in communications with you, Daljeet ji. What were the 2 or 3 points that you were saying may seed a new bull run on Dalal Street? One is, of course, rising corporate incomes. The second, I think you mentioned, was the cut by RBI.
Yes, I think that was a very timely reduction in the interest rates by RBI, and in fact they went double on it. So which was not many people were expecting. I think they've done a very good step there, which will be very helpful. And along with the higher rate cut, this liquidity infusion by CRR cut 25 basis points every month, or full 100 basis points, leading to 2.5 lakh crores coming back into the system. I think this will be a very big booster for the consumption. Although consumption had started picking up slightly, we have seen in the past inflation issues have been rearing up, but now they have been taken care of very well. So when inflation is taken care of, you start the interest rate cut cycle. We have always seen in the last many cycles that the start of the rate cut actually leads to a big good jump in the equity market returns. So we believe that this consumption-led growth will come back in a very good shape in next probably 2 quarters. Normally, the rate transmission happens over a period of 3 to 6 months, and by that time we will have our festive season also coming in. So both these things will help in generating that consumption growth. Third is the if you see this issue about rupee getting strengthened, no? The dollar inflows coming back. We are very firm believer that dollar inflows will be back because people have now somehow lost some faith on dollar. No? Some confidence on the U.S. currency has shaken. No, of course, it has been there for ages, so it is not going to go away tomorrow. We are not saying that tomorrow all over the world people will start just taking away dollars and start putting it in India. That's not going to happen. But we just need incremental flows, no? And those will start coming in. So that again will probably aid the equity market returns. Therefore, we believe that this confluence of all these three things, along with of course the normal monsoon, etc., those regular things, these will ultimately lead to a good corporate earnings growth story, consumption-led growth story, and therefore equities shall be in a good shape in the next 3 to 6 months.
Okay. Daljeet, would you estimate how much would corporate earnings in terms of basis points rise by this front loading of the RBI cut, and more importantly the reduction in the CRR? That essentially means that there is a lot of liquidity available, and corporates may be with light balance sheets be happier to borrow to fund capacity expansion. Any ballpark number your research team has thrown up as to how much earnings may rise in terms of basis points?
So, Shailendra, we don't make any estimates about the Nifty or the headline indices because we invest, as you know, from bottoms up picking. So, we invest in very deep research stocks at the stock level. But I can tell you that in our portfolio, the 25 stocks that we own, their earnings growth we have estimated as 45% for FY26 and 25% for FY27, year on year growth.
Okay. Have you made any changes to the top 5 that were there earlier in your portfolio? If you can just name them.
No, we have not made any major changes in our portfolio. The top 5 is the outcome, no, and that will depend upon the stock price also. One thing will go up, other will go down, so that will remain. But more or less, the portfolio construct remains the same. We have a couple of consumption-related names, which includes home appliances to luxury car dealer. We have real estate developer, we have construction company, we have power financer. So it's a wide variety of stocks, which are around 25 stocks we have. The top 5 will account for almost 40-45%.
Daljeet, in the space of mid cap or small cap NBFCs, low ticket items, look at Aditya Birla Capital, L&T Finance, maybe even Capri Global. There is a lot of investor and trader interest coming. Block deals have happened in the past 15 days or so. And in the larger NBFCs, the established ones, record highs on Muthoot Finance, also Mannapuram Finance. Can you please help our viewers understand what is the underlying reason why these stocks are now in the momentum space?
So see, NBFCs, I think now the good times have come for them. They were going through a difficult patch last few months. I think for at least for 2-3 quarters, they were in a little difficult shape because cost of funds was going up. And at the same time, the asset quality was slightly deteriorating because borrowers were in a difficult situation. Both the things have now started improving. With the help of rate cut, they will improve even more. So once the rate transmission happens, the cost of funds will come down for almost all of these NBFCs. And borrowers also, they will be also in a better shape once they have little lesser interest to pay than their disposable income will be slightly better. So I think good times will come for these NBFCs. And therefore, this is the time to start looking at these companies. Some of them have moved ahead of the fundamentals, and therefore, valuation might have gone up. Like Gold Financer, you talked about. In our view, they are priced to perfection. There we might probably, as of now, still wait for the price to correct. But we are looking for other finance companies, NBFCs, amongst in various subsegments. Although right now we have only two NBFCs in our portfolio. One is in housing finance and the other one is in power finance. But yes, we are looking for some more to add.
Okay. Are both NBFCs from the private sector?
No, so power financing is the public sector, one of the largest out of the two big power financiers. We have one of them. And the housing finance is the private company.
Is a private company. Okay, fine. Let's look at one part of the market where Daljeet ji, long-term investors have been disappointed, which is cement. Very strong rally coming into real estate players, but cement as an ancillary not really benefiting. You have outperformers like JK Cement to some extent, which have been trading at record highs, but nothing has moved. How are you playing cement in Roha Asset Managers? Is there a representative from that sector, or are you keeping away?
We have one stock there, but it had actually gone down much lower one after our buying, so we had to wait for some time. Luckily and good that now we all, of course, we had that view that it will come back. With this quarter numbers, the stock has come back with a very vengeance. So almost 40-45% return in last 2-3 months the stock has given. So it is back to our buying, or in fact slightly better than that. View is that cement will now again start performing because what had happened that one, that the industry was going through a lot of consolidation, pricing power was not coming up, and this is very peculiar industry. Here, Shailendra ji, you will notice that actually being very big is not going to help you. Yeah? Because a small guy, if he cuts down the prices, you are forced to cut down the price. So even though you have a 80 million, 50 million ton capacity, a guy with 5 million ton capacity will come and reduce the price by 5 rupees a bag. You have to reduce it because there is no differentiation in the product. Right? So it is all about the costs that you manage. It is about the logistics that you manage that will take care. So ROE therefore is very important. Your entry point in terms of stock perspective, entry into the stock is very, very important. Entry price is very important. Both these things, whenever they are in your favor, you can take that as an opportunity and probably play out for a good run of 20-30. The good part is that the stocks in cement, they give you very good returns in a very short time. So you have to be very opportunistic. It won't be that it will be buy and keep it for 3 years, and it won't work that way.
You see, long-term holders of cement stocks have been, grappling with disappointment for now, I think, more than a decade. Market has doubled. Nifty has gone up 2.5 times. Stock वहीं पड़े हैं cement के. बहुत रुलाया.
Correct. Exactly. So because that's the commodity cycle, where this is where your entry point is very, very important.
Yes. Daljeet ji, between the time we met last and today, sadly, we've had two wars, one between India and Pakistan and one that's ongoing between Israel and Iran. This has become the new normal which investors such as you are now grappling with. In the light of this background, how do you see now defense counters? Even today, see, rally is back in front lines, shipbuilders, all PSU government stocks. How are you staying away? One, and if not, if you are invested, how are you holding on?
No, so Shailendra ji, we are totally out of defense. We don't have any single defense stock in our portfolio purely because of the valuation. All of
तो
these
फिर तो
stocks
आपको तो
have
बड़ी
done.
फोमो फीलिंग होती होगी.
नहीं, बिल्कुल नहीं होती, क्योंकि दिस इज अ कॉन्शियस डिसीजन. Because whenever we analyze, we find that these stocks are totally out of valuation zone. So somehow, with that thought process of last 3 decades, we cannot compromise on that. How to buy at these valuations? So yes, people might have made a lot of returns, but if you remember, in February, March, when the markets came down, all these stocks came down by 50%. Of course, because of this war, these have come back again. But even now, after 30-40% up move, they're still lower than what they were 6 months back. So my point is that these are good companies, very strong companies. There's no issue about them. They have now strong order books also. But there is a execution dilemma there. No, they will take their own time. They don't have that capacity. No, we have on record the air chief saying that none of the orders are fulfilled at the time. Even then, market is willing to believe that these companies will come out with, will achieve their numbers in next 3 years, 2 years. So slightly difficult for us to digest that. That is why we still are out of these stocks.
Okay, fair point. The other space that requires your attention, Daljit ji, is the way IT stocks are behaving. You know, Frontline, HCL Tech, TCS, Infosys in particular, are sub growing at sub GDP growth. This is not something that we had ever hoped to see. At least I haven't. Within the frontline IT, because you pay attention to so much of valuations and affordable valuations, does it have a presence in Roha Asset Managers, frontline IT, or are you avoiding them for any other reason?
No, they don't have any presence. First, because of course they are out of our mandate. We are only in small and mid cap, so most of them are very large cap or mega caps. So one is that reason, but that's less of a reason. More of a reason is that we don't see their growth coming back in a hurry. Mainly because their major customer is the US economy. And if that economy, if there is so much of turmoil there, if so many things are happening every day there, one tweet, things changing, another tweet, another thing coming. So how will the companies decide what to do and which services to take, how much to take? Therefore, the growth is a challenge there. And India has been a growth market. We have choice of so many growth stocks available, so many other industries available. So why should we look at such kind of sector where we know that there are challenges? We, as of now, we are avoiding. Maybe at some point of time they will become attractive. That time we look.
Daljit ji, how are you shielding your portfolio from the bad impacts of what is happening globally, whether it's a decreasing dollar, whether this is the tariff war, which sometimes is relentless, sometimes pauses. How do you sort of keep your valuation parameters within the Excel sheet, which somehow avoid the carnage that's happening globally?
So first thing is we have mostly domestic oriented portfolio. Out of that 25-30 stocks that I spoke, I think almost 80 to 85% will be domestic oriented companies. No, they won't have, or if they have exports, it will be 5%, 10%, that kind of number. A couple of pharma companies are there, one or two agrochemical companies are there, which have some foreign exposure, but that too less to US, more to Europe. So that way we have designed the portfolio in such a manner that 80 to 90% is domestic economy. And within the domestic economy also, they are mostly very bottoms up approach kind of thing where it is led to be, it's related to the consumption, it's related to the rate cut cycle, it's related to, it's basically not dependent either by way of finished goods or by way of raw material on the global world. Of course, nothing works in the sole environment. Everything is joined, but they are much lesser impacted, I would say. So that way, stock selection, like real estate developer, they won't have any impact. No, what is happening in the global? It will be so regional. And we talked about cement. We talked about the construction company, which is building the buildings for the real estate developer. So a glass company, they are hardly impacted by what is happening globally.
True, fair point. I think that's the only way. Remain domestic focused and play out the theme that you feel is least impacted. Something that's gone off the radar are jewelers. That's mainly because of the way gold prices are behaving. I don't remember the last time Titan was discussed in great detail. How do you see this space in terms of valuations? The GG Titan has done nothing since January of 2024, and so have other jeweler stocks been quiet. How is this theme represented at Roha, if at all?
No, we don't have anything of this kind in our portfolio. We have consumption-related, retail-oriented stocks, but they are through home appliances or small appliances rather than jewelry, etc. And purely because of this, one, that their valuations are always higher. Second, high valuations are justified if there is a high growth. Now, if the growth itself becomes challenged, then high valuation becomes little difficult to justify. And with this kind of 1 lakh rupees, 10 gram of gold and all, of course, the growth will be challenged. No? People would rather invest in gold directly rather than buying the stock of gold jewelers. No? So, and commodity as a gold has done very well. So, I think for this turmoil is there. We have to wait it out for time. And valuation wise, they don't fit into our criteria.
Okay, so that's the theme that you have in mind so far. Daljeet ji, thank you so much for your time, and as always, the very best to you as far as this portfolio is concerned. Let's hope the 45% CAGR growth that you see on earnings front translates in a far better fashion on stock prices. Thank you for your time.
Thank you.
That, ladies and gentlemen, was Mr. Daljeet Kohli, the top man at Roha Equity Advisors. It's an inward-looking domestic portfolio of 25 mid-cap to small-cap companies that Daljeet ji runs, focusing on themes such as domestic appliances, a bit of housing finance and power finance, and stocks that look at growth in the domestic market. Thank you for watching. Stay glued to Business Today Television. There's a lot that's happening on news.
Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is your favorite show, Daily Calls, a show that answers all your stock-related queries. In case you're here for the first time, well, you can